Hi, everyone. Thank you for coming to our monthly webinar. And today is what we're calling our back to school special, because we know all the parents are busy getting their kids back into school and back into the routine after a busy summer. And with that, we wanted to talk about a really special topic to all of us, which is college savings plans. So you may hear it as 529 plans, 529 college savings plans. We've got a lot of great, we've got parents, grandparents, even godparents that have set up 529 plans for their favorite children. We always say children are probably the biggest investment, the greatest part of our clients' legacy. And so we love kind of talking about college savings plans as part of the planning process. And so we thought we would do this as a little kind of fun refresher and maybe a true or false kind of style. And so, and of course, with me, we have Trevor McCarley, our associate advisor, with us to shed some more insights and light on the topic as well. So we're going to share our screen. So give us a moment to do that, and then we will get started. Okay, so the 10 myths about college savings plans. Let's rock and roll. Well, before we get started, I did want to introduce you to our team because we do have a couple of new faces. And so first of all, as you know, Jay, of course, our founder and president, and really the one who oversees all of the clients, makes sure that things are running properly, and our fearless leader. And then, of course, me and Trevor are there to take care of the clients and answer a lot of the technical financial planning questions. And Trevor is really involved with doing the due diligence and implementing a lot of the strategies we have for the portfolios. And then, of course, in the bottom row, we have Kanchan, who I think is truly our boss, because she's the one who pays writes the checks and makes sure our paychecks are in our bank accounts. But she also takes care of the compliance and accounting. And then, of course, I'm sure you've heard from Jasmine. Jasmine is our client relations manager. So as she likes to say, she does all the fun stuff. She makes sure our clients are meeting with us on a regular basis, and then she plans all the fun events and activities, including webinars like this. And then I also would like to introduce you to Demi Jackson, who is our new client services manager. She joined us just a month ago, and she's really responsible from everything from account applications, transfers, adding money, taking money out, administrative updates, you name it on the service side, and she'll be there for you. So, you know, we are so proud of our JayKay Wealth Advisors teams because we really wanted to make sure we have a strong group of people that are there to take care of our clients. So I'm sure you'll hear from all of us during the year, and especially towards as we get to the end of the year, with a lot of exciting things coming up. So with that, let's get started. Now, I don't think I have to convince you as to why college education is important, but here are some interesting statistics about college graduates compared to their peers. But that said, I think the real reason why we like to talk about college savings plans is because it relates to what we find is most important with our clients. You know, when we talk to them and when we ask them, what is important to you about money? What do you want to achieve with your wealth? What do you want your wealth to do for your family? Most of the time, if our clients have children or grandchildren, it's about taking care of the family. And I love how one of our clients put it, you know, they had worked really hard to get to this point in their lives where they're comfortable, they can take care of themselves. But it came at it came with a lot of sacrifice. And some of the things they had to do in their life was because, frankly, they just couldn't afford to do some of the other things. And so when they talk about what's important to them about money, for them, the way they answered it is they wanted to make sure that they were providing as many open doors and opportunities to their children. And the beautiful thing is the college savings plan is one way to do that. It's one way to help and provide for your children and your grandchildren. And the nice thing about it too is that there are some tax benefits that come along with it. There's some tax advantages that come with investing in this account. And so, yes, we can, I'm sure there's a lot of opinions as to whether college is important or not, but when it comes to many of our clients, it's really about an option that helps them achieve what's really important to them, which is taking care of their family. So who cares about being able to afford college? The reality is, and I'm sure you've heard the statistics, is that college is only getting more expensive, and it's starting to cause a lot of stress when a lot of our clients think about taking care of their children and providing for that college education. I will say, it's not even just the tuition, but you think about room and board and books and computers and the extracurriculars that go with it. And so, providing that full experience for the, their children in college. That said, to be honest, when we run kind of calculations on the cost of college, we're putting about a 6 to 7% inflation rate on how college expenses will increase over time. And so we understand that can certainly be stressful. And that's why, these are some options that we have available to start planning and doing something about it. So we're going to test your knowledge of college savings plans. And hopefully this will be a great way to kind of bust some of the myths that are out there and clear up some things. Before we even begin, so we're going to actually go over 10 different kind of questions around 529 plans. But before we go over that, I do want to just get the basics out there first. So the college savings plan is set up in a really interesting way because our clients have the opportunity to contribute to the 529 plan with after-tax dollars. So they do not get a deduction upfront for contributing to the 529 plan. And then the funds are invested. And as it grows what we call tax deferred. And what that means is you don't have to pay taxes on the growth, the capital gains, the dividends as it grows. That's what we mean by tax deferred. And then the withdrawals are considered tax-free. You do not have to pay taxes on it as long as it's used for a qualified expense. And we'll talk a little bit about what is considered a qualified expense. But generally, these are how 529 plans are set up. So now let's kind of bust some of the myths, do a little bit of true or false, and let's get going. So Trevor's going to start us off with the first fact.
Okay, here we have our first fact. And as Anasuya said, this is going to be all true and false, but be careful. You're probably thinking, oh, it's all false. That's the point of these things. There's a couple of trick questions. So, not all true, not all false here. Our first one here is a 529 savings plan can only be used to save for an in-state school. So a lot of our clients obviously are in Texas. We have a few scattered about throughout the rest of the country. But think about it. The idea here is you do not have to, because you're in Texas, you do not have to open a 529 in Texas. And then your kid does not only have to go to Texas. So of course that is false. Mm-hmm. So your kid doesn't have to go to A&M or UT or U of H. Granted, I think they should go to A&M. If this 529 savings plan can be used in any state for any qualified expense, whether they want to go to Boston, California, Utah, wherever they want to go, Chicago. Yeah. What are these qualified expenses? Well, in summary, college tuition, room and board, books, required equipment like computers, essentially anything they need for school and not for partying. Mm-hmm. It's a good way to put it. But be careful about that, though. There are some which you would think would be qualified expenses, but they're not. Watch out for expenses that aren't qualified, such as insurance, transportation costs, So anything off campus like car, gasoline, bus fare, and repayment of student loans, which makes sense because if you had the 529 plan, you would use that before taking any loans out. As well, a new addition in more recent years is these accounts can be used for private school tuition, K through 12. It's not only colleges, but there are some non-tuition expenses that they cannot be used for. And for those thinking, well, what if our kid doesn't want to go to college? We don't really, it's young, we don't know. We think of these as undergraduate, master's degrees, doctorates, but many of these plans can be used for professional trade schools. So gives you a little more flexibility than you think you'd have. Yeah.
Nice. Okay, numero dos. Number 2. True or false? You are better sticking with your local state plan. So if you're not aware, a lot of these college savings plans are sponsored by each state. So each state has their own 529 plan. So the question is, are you better off sticking with your local state plan, true or false? The answer is false. So, and true. Watch out, watch out. So there's some things to think about here. And when it comes to which 529 plan should you use, there's a lot of states that offer different ones. It, like Trevor mentioned, you mentioned earlier, you know, because we live in Texas, it's a little bit easier. We don't have state income tax, but there are 529 plans out there for a particular state where they do give that state income tax incentive. You get a deduction on the state income tax for the contributions you make. So for example, our clients in California, Washington, Oregon, New Mexico, you know, sometimes we do think about whether it's better for them to do their state sponsored plan there as opposed to somewhere else that some another type of plan. But that said, you know, the other factors to consider in your 529 plan is what investment options are available to you. What are the performance looks like on those funds, the fees and things like that. That's still really important. So when it comes to deciding which plan to choose, it's a little bit of true or false, whether you should stick to the state plan or kind of explore what other options are out there.
Yeah, the summary there is if you're not going to get any tax benefits, then just go to any state that has the best plan.
Yeah,
So,
that's why Texas is a little bit nicer because we do have that flexibility there too, for sure. Okay, number 3.
okay, so 529 plans cannot be used for adults. Now, is that true or is that false? Well, that's a big fat false. While 529 plans are often thought of for your kids or your grandkids, if your kids don't use it, well, guess what? You can use it. There are no age limits to using the 529 plan. We're seeing, you know, on occasion, I don't know if you know, your kids in school might see retirees taking classes just for fun, just to learn new things. Well, if they're doing that and they had a 529 plan sitting around, they could be using it. Unused money in a 529 plan, what we're seeing more of though, is if your kid gets through school and doesn't use the money, gets through master's, goes on, decides not to continue any more education, you can just transfer that to your grandkids as well, or cousins, or we'll go a little further on that. But the scope of what is considered a relative to the federal government when it comes to 529 plans is pretty broad. So
nice. Yeah, I would say, you know, the nice thing is because, right, Trevor, the owner on the account is, say, the parent or the grandparent, exactly, and they get to choose who the beneficiary is. And that's what makes it nice. There's some flexibility. You can change who the beneficiary
exactly,
is.
Yeah. And we'll go into that a little more in a later slide as well.
Okay, number 4, 529 plans are just for traditional 4-year colleges. True or false?
Unfortunately, I think I might have given this away already.
That's good. Let's see if people were paying attention then. So the good thing is this is false. You don't have to go to a traditional 4-year college. You don't have to use a 529 plan on just traditional 4-year colleges. It can be used for junior colleges, community colleges, training programs, postgraduate programs. So and even certain, as long as it meets certain federal accreditation, did I say that right? Standards.
Yeah.
then it can pass. So in fact, we've even had clients, I can think of so many examples, clients that have used it for their children's pharmacy school, nursing school. Their children have gotten PhDs, so their postdoc programs, things like that. We even had a client who got her PhD in Cambridge, or their daughter got their PhD in Cambridge, and they were actually able to use the 529 plans there. And we had to kind of check on it. I mean, it's not like we can take it for granted, but it is something to check on. So, and then of course, other types of grad schools like law school or med school. So, something that we've seen with certain clients is, their children may have gotten scholarships, or they have other benefits, say through the military. And so that's when we're like, okay, maybe we can change, maybe the 529 plan will be used at a later point. So there's a lot more flexibility than people think on how it can be used. Okay, number 5.
Question number 5. 529 plans are difficult to open and maintain. Well, this one is again false, but I understand it can be a little difficult to do it on your own. Things are getting easier nowadays with technology, but at the end of the day, it's simple because the ones we're dealing with here obviously are professionally quote unquote sold plans. You're working with us directly as your financial advisors. So we're helping you set the allocations, and that's going to depend on how long your kid has until college, more often. But often we see clients who, if they have not gone back and reviewed plans that they set up on their own, the kid's 15 years old, the allocation was never changed. He's going to graduate in 3 years. And so therefore he has a lot of stock, a lot of equities, very little bonds, very little cash in the account, and the market takes a dive. So, which is going to set him up in a worse place than he would have been if he had reviewed that allocation every couple of years as that kid got closer to college. So that's one thing we do a lot with our current clients who have 529 plans. Just checking the allocation, make sure we're on track. We're not being too aggressive as they get closer and closer to needing the funds. Additionally, we are also working with our clients to do some cash flow planning. So let's identify what expenses they're going to have this next year or 2 in college. What is a qualified expense? What is a non-qualified expense? What can we pay directly to the university, make it easy for tax purposes? And what do we need to send them a check for? And, they just need to help them, guide them on what kind of receipts to keep in case the IRS comes knocking and asking, hey, what's this distribution? Oh, well, that was a laptop for college. So it's qualified.
Absolutely. And I think, Trevor, you started talking about it a little bit too, is we've even seen some clients use this as an opportunity to teach their children a little bit about financial responsibility. So, sharing, like if you felt comfortable, we've seen some clients do that. They share the account balance of the 529 plan and they say, hey, you're the one who has to call Trevor and Anasuya and say, I need this much for tuition, and obviously we have to get the client's approval, but, giving them some responsibility in managing how the tuition is paid and how the account is also used. So it's kind of interesting how we've gotten to kind of get to know the kids in that way too.
Okay, so question number 6. High income earners cannot contribute to a 529 plan. Well, this one is again not a trick question. It is false. There are no income limits on 529s, as opposed to a lot of retirement accounts and other savings vehicles. There's no limit on your income that will affect what you can place in a 529 plan. Everyone is eligible, no matter their income, deductions, tax brackets, tax credits. And it is actually a useful item for estate planning. We'll kind of go in that a little bit more later, but to give you we'll actually do that now. So when we say it's useful for estate planning, currently the rules that are around a 529 plan is it's treated as a gift. So a lot of the numbers you're going to see on the slide here is from last year or two when the gift tax exclusion amount was $15,000 per person. Now I believe it's $16,000 per person this year. What that means is I, as an individual, say for my nephew, can gift into a 529 plan in his name that's 16, or let's leave with the old numbers, $15,000. And not have to report that to the IRS, not to pay any income tax, not pay any taxes on it. I just put it in a 529 plan. It takes it away from my assets, out of my estate, and is now considered the kid's money. But guess what? It's a gift, but I still have control over it. So I can decide to change the beneficiary. Say, the nephew doesn't need the money, he's fine. I would change the beneficiary to my daughter, later down the road. So you're able to give money away, while also keep control of it. Now, you can also maximally fund a 529 plan. And what that means is you can actually put 5 years worth of contributions into that plan in the first year. So instead of giving $15,000, I could do $75,000. And if my wife and I together wanted to give, combine our amounts, that would be that $150,000 you see here under the 5-year accelerated gift rule.
I'll just chime in here. This is something I see a lot of grandparents looking at.
Yes.
So for parents, it's kind of sometimes like a balancing act, between saving for retirement and saving for their children's education. But for grandparents, I do see them, thinking about this option. So.
Yeah, and you're seeing a lot as well of the grandparents already have this money kind of earmarked. They want to give it to the grandkids eventually. And they don't mind earmarking it for education. They like the idea, they like the tax benefits of it. It takes, their kids don't have to worry about it as much. They can save other things for the kids, weddings, all the other expenses that happen that I don't want to think about right now. So yeah. And again, because it's considered a gift, all the other gift tax rules, apply. You can gift up to your lifetime exemption amount. I don't know if anybody's going to gift 11 million to 529 plans, but in theory, you could. And we'll kind of expand upon this in the next slide. So here we actually have an example. We have Susan and Howard, who are grandparents. They have sons and daughter, Adam and Jennifer, who are married. And Adam and his wife have 3 kids. Jennifer and his husband have 2 kids. Well, Susan and Howard, they can each gift $75,000 per grandkid. So they're putting $150,000 each total for each grandkid into a 529 plan. Now, if the kids also wanted to do this, they had a lot of cash sitting around as well, they could do the same thing. And now you have, well, the grandparents have removed $750,000 from their estate taxes, or estate that could be subject to taxes. And parents have removed, well, $450,000, $300,000, depending on the parent. But point is, these kids' colleges are pretty well set from the get-go, and how good they are, and how much education they go through. I guess they could really go to Harvard on this money. So, a kind of an extreme example, but just kind of give the idea of what's allowed in the gift tax world.
Yeah, this is really powerful because, like Trevor said, like if clients have accumulated a lot of cash, they they know, like, I think about it really from the perspective of grandparents, where they feel like their retirement is comfortable. They know they've got the money to take care of themselves, and now they're focusing on that second goal of taking care of the family. Exactly like you said, you can invest. The reason why I find this really powerful, I'm going to say it again, is because many times we have clients that are just investing in like a usual brokerage account, and they're paying taxes on capital gains, dividends, income each year, even though that money they know is eventually going to go to the children. So instead, we could put it in the 529 plan where we're getting some of those tax deferred growth, and you're still doing a little bit of, some of that estate transfer and gifting as part of the process. So it's kind of killing 2 birds with 1 stone, taking care of the family, kind of be doing it in a tax managed way, and doing some wealth transfer as well. So totally agree with you. And I really like the way you explained this. Okay. We are rocking and rolling.
Okay.
Sorry.
I'm not sure who's supposed to think of something. I'll do it. So this really just kind of goes off of the last slide there. Gives a more explanation, less example. It kind of explains that front you're loading a little bit more. And you may be thinking, well, I don't want to put those money away. You don't have to. This is just something that's just available to you. We have some clients who want to put a big chunk away, maybe not 150,000 for their kids, but 175, 80, because their kid is say 5 years old, 6 years old, even younger, and they already had, like Anasuya said, they have the money that they would put into a standard brokerage account. It's going to get taxed. They know they're going to need it for college. They have 2 kids. They're going to go ahead and put in a 529 plan. Let one kid use up what he needs. Change the beneficiary name to the other kid. Let them use up what they need. And oftentimes, I mean, it's the account's empty by that point. Anasuya a little bit more into how we've never really seen these accounts get wasted, quote unquote, so far.
Yeah.
But go on to that next.
Absolutely. And I think this is another kind of point regarding 529 plans. A lot of times clients may want to set up trusts for their children, trust for beneficiaries, and when it comes to trusts, irrevocable trusts specifically, where you are truly relinquishing control of the assets, the tax rates on those irrevocable trusts are very compressed. And so as you can see in 2019, the trust income in excess of just $12,000 is subject to 37% tax, the highest tax bracket. So that's another reason why I keep talking about this tax deferred growth, because if the money is going to be used for education and these qualified expenses, might as well put it in a place where it's kind of protected from paying that 37% tax rate, even if it is in a trust. And so I really think I every time I think about college savings plans, like if your child has that potential, wants to go to college, you want to encourage that. I really see so much benefit in it. Okay, number 7. You will lose your savings if your child doesn't go to college. True or false? Now, I think we've kind of mentioned it, but that is false. And, there is so much flexibility on it. Assets can be transferred to yourself, to any family member that's a beneficiary. So the other thing to know is, let's say you really can't find a beneficiary that you would transfer it to, or you don't want to keep it for yourself. You just want to take the money out. Well, what we have to remember is that your principal is not taxed, right? You've already paid taxes on what you've put in, and you'll pay taxes and a penalty of 10% on the growth. So the difficult thing though is when you take money out of the 529 plan, you can't just say, hey, I want to take out what I put in. I want to take out just my principal. The government won't allow you to do that. So when you take out a distribution, they're going to take out a proportionate amount of what you put in, the principal and the earnings and growth. So each time you take a distribution, you're still going to have a little bit that's taxed and penalized if you are not using it for a qualified expense. Okay. So, but I think really when it comes to it, I really haven't seen a client waste the funds. And so I think there's a lot of potential, a lot of room for how these funds could be used.
Question number 8. Can anyone contribute to a 529 plan? That's absolutely true. Anyone. Even if your parents have set one up for your kids, or so for their grandkids, you can put money in that 529 plan. If you set one up, and the grandparents want to put money in, they can. Just because the person who owns the plan doesn't have to be the person who's solely funding the plan.
That's right.
Aunts, uncles, cousins, complete strangers, legally they can. I don't know why they would, but they can. And I mean, especially young kids nowadays, we're looking at them going, you're 10 years old, you have plenty of toys. What do I get this kid?
Yeah.
It may not be so much fun on Christmas Day, but I know I've done it. Anasuya definitely has personal experience with it. Just write a small check, what I would have spent on toys, and put in the 529 plan. So that's always an option as well.
Nice. I love this. I totally agree with you. And some of our plans too, it's just simple. We just tell them who to write the check out to,
Yeah.
and the parents or the grandparents, the family, friends will just do that. So, okay, number 9. This is a big question we get a lot. Savings in a 529 plan can dramatically reduce financial aid eligibility. And I have to be honest with you, many of our clients, most of our clients are high income earners. So it's rare that they're relying on financial aid to begin with, but I do think it's really important to go over. That is false. And the reason why is based off of, who the account holder is. So typically we set the account up where the parents are the custodian and the beneficiary is the children. And we don't set it up where the children are the owners, right? Because then you're giving up control. But two, it's because of how federal financial aid is calculated. So they look at what the student can contribute versus what the family can contribute. And as you can see, the student's contribution, the percentage is much more than just the family's contribution. And so that's a big reason why, even though a parent or a grandparent might save in a 529 plan, it is a factor in financial aid, but it doesn't necessarily dramatically reduce it.
Yeah, and there are strategies around this to help maximize that financial aid even with a 529 plan. So for parents, you go off these percentages here. For grandparents, it's actually more beneficial and very tax advantaged to actually wait until the beginning of their junior year of college to withdraw from that 529 plan and put it in and pay for their school with it. Yeah. Reason being is that they're actually looking at the past 2 years of contributions towards tuition and income taxes. Now, they're not asking for the grandparents' information, only the parents and the students really, typically. So when the grandparents contribute, they consider that the student contributing, interestingly enough. But again, they're looking 2 years ago, not necessarily right now. So if you do it towards junior year, or if you wait till grad school when they're done with their undergraduate, that can be the most beneficial way to maximize financial aid while also take advantage of these 529 plans.
Yeah, absolutely. No, you don't want to rock the boat too much, right?
Yeah. So there's just a little bit of strategizing involved.
Absolutely. And, obviously we're talking a lot about college savings plans, so we're going to say a great way to save, but, it's important that we look at what other options are available for our clients depending on the specific situation. And so, sometimes there are other types of plans out there. Coverdell, clients may have life insurance that's built up a lot of cash value, annuities, IRAs, Roth IRAs. And while they are options for funding college education, there's still pros and cons to doing each of those. So, for example, with a Coverdell account, unfortunately, the limit for contributing to that is $2,000 a year. And I believe there are income limits to people who are eligible for contributing. So, it's not as much that you can really accumulate in that account. IRAs and Roth IRAs, of course, we have to be careful about whether you're at least 59 and a half before you start taking distributions from that. And then life insurance and annuities, while they do provide some options, I do believe there's pros and cons to it. So, we have to watch out for how much you're taking out of the cash value of a life insurance.
Yeah,
policy.
especially on annuities, they have that same kind of 59 and a half.
That's right.
Rule for IRAs. We've actually, met with clients in the past where we have a decent amount of money in the 529 plan, and already this year, should I put more in, or should I go ahead and max out my Roth IRA? Well, if they're older, I say older, they're going to be about 59, 58, 59 when their kids start college, then yeah, it'd be a good idea to go and put it in a Roth. So that way there's no wasted money. You've got money in the 529 working, you use that up first. If you need to take it from the Roth, you can. If you're past that age point, you can take it out without taxes, without penalty. Yeah.
I think this is our favorite part of working with clients on, cash flow planning for college, right? Is like looking at all the different assets that you worked so hard to build up and how can we really use it strategically to fund the different goals that you have. And so, I think even though 529 is a primary way of funding for college, there are other options that are out there and we have to kind of weigh those pros and cons and see what makes sense. Okay.
Okay, so if your child wins a full scholarship, you may pay penalty and withdrawals from 529 planned assets. Mostly false, but not completely false. So like we said before, savings can be transferred from one family member to another. So if one grandkid doesn't need the money for school, you can transfer that to another grandkid, or great nephew, niece, what have you. And there is generally no tax penalty and withdrawals, again, from principal, as we said. Now, you can't really tell them which part is principal, which part's not, but that rule is there as well. But interestingly enough, you actually can withdraw amounts equal to the amount of the scholarship without penalty. Now, you may need to pay taxes on the earnings in some cases, but you won't pay that 10% penalty. So at this point, it becomes kind of more like a standard brokerage account. You're not getting penalized for having it, but you're still going to pay some taxes, just like you would anyways. And some interesting points on, will your kid get that scholarship? Well, to be honest, only about 13% of students in college now receive any type of scholarship, and less than 0.5% receive a full ride.
Wow.
I like to think that my 4-month-old is going to be a genius, but let's be honest, she's going to be a little above average, I hope.
Yeah, she'll be great.
No, even if she is less than 1/2% she's more likely to win the lottery. So this is why we say, another reason why we say 529 plans are often not wasted. If you've built up a decent amount of money in there, again, college is getting more and more expensive every single year. That 6.5% to 7% inflation rate we use to plan for college expenses. I mean, we were using that when standard CPI inflation was under 3%. So I don't know what it's even done in the last 18 months or so, or it's going to do next year as far as college tuition goes. But I can imagine it's going to only continue to increase the way it has been.
Okie dokie. So we went through 10 facts or actually myths, and hopefully we busted those myths pretty well. And I think it's really fun kind of talking about some of the experiences we've had with the clients we've worked with. It's really wonderful. Like, we've seen parents that have saved over the years and now their kids are 18 going to college and, really like enjoying the benefit of it. We see grandparents that are gifting that money and their grandkids are going to college. And it's just a really cool, it's just really nice to see that opportunity, those open doors are there for children in the next generation. And, I know it's something that a lot of our clients worry about. And so like, I think we've mentioned it before, but I think it's important to say again, there's always that balance between saving for yourself and what you need for retirement and, other personal goals that y'all have, as well as taking care of the children. And sometimes a lot of the conversations that we have with clients is really around that and planning around that. And so, I think we just want to thank you for joining us today and talking about this great topic. We are really passionate about, looking at the different ways of taking care of these kinds of goals, especially when it comes around your family and your children and your grandchildren. It's exciting to see how these things come together. And so, of course, I do have to show you these lovely disclosures, but with that, we'll open it up for question and answers. And if you have any questions, we'd be more than happy to talk about it right now or even after separately one-on-one.
Yep.